Good morning. Welcome to another edition of Swing Trade Newsletter. It's been a while since we chatted, so let's get started. Let's dive into the markets here real quick. Looking at the markets now, we've clearly seen a massive bull run, after the Trump election, and what has caused is a lot of surprise, right? People didn't expect that. People expected, the market to sell off after the election. They never really expected this type of advanced. Even people who were not quite skeptical, who perhaps were not expecting a decline, but were clearly not expecting this type of a run. But look at what we've got. We basically just went up, a little dip, went up, a little dip, consolidated sideways a little bit, and then the market ended up taking all the way up higher again, right? And then after that, got a little consolidation, another move higher, slight dip, another move higher, slight dip, another move higher. But all this while, what's been happening is when you get these declines, you're not able to follow through or actually continue down lower. Every time you decline, right, the decline is followed by another massive rally. And look what we've got here now. Now the market has got another little decline. Now the question now is the market going to fail? Right? Is it finally going to give in, start selling off, or is it going to hold here again and continue what we've been seeing all the way through here, which is every sell-off tends to get bought. So before we dive in, let's take a look at the weekly chart real quick, and also let's take a look at the monthly chart. Now, clearly looking at these charts, a pullback is likely, right? A pullback is likely. Now, what we've seen last couple days is we got a break of support, right? The market breached this little support zone that was forming here, breached it with a massive red bar, but in the end the market ended up coming down into another support area. But what we've got is a big red bar, and then the following day on Friday we got a little doji bar. So what we basically have is potentially a start of a 3-bar play, right? If you know what a 3-bar play is, if you've taken the courses, right, if you watch the video on YouTube, you know what a 3-bar play is. And based on that pattern, it's possible that the market perhaps, right, wants to form under a red bar, or perhaps continue lower, right? Another red bar down, and that's clearly possible. And that would also make sense, because that would mean, the market breaks this green bar and the red bar is low. It could potentially sell off with another red bar, and that red bar could pull into this low of the support, which would make sense because this area is, a decent level of support. So the market could potentially pull back into that. But what we've also seen last few times the market tried to do that is pretty clear, right? Now, market never really formed a 3-bar play. Every time, the market formed this type of a pattern, right, it rallied. Look at that. Got this type of a pattern, market rallies. This type of pattern, market rallies. Tried to do it here again, market rally. So every time we've seen this pattern, it's rallied. But every time we've seen this pattern, the market has rallied. However, here's what's interesting and different this time around is look, every time when you got this red bar, the next bar actually pierced the low of the day. It's not necessarily a valid 3-bar play. Same thing here, market put in their red bar, but then the green bar pierced that low. So it's never really a 3-bar play. However, this time around, it's a clear inside bar, which is interesting because, break of that could perhaps signal a move down. Look at here again. Look at this little move down right here. Move back up a little bit. See that again, red bar, but then the green bar takes out the low, and that causes a comeback. This time we didn't take out the low yet. So if you do next week, potentially could be a 3-bar play, something to be concerned about. That's how the spiders look at the moment. We also got to recognize, we're heading now into August and we're heading now into September, right? August, September are typically slower months for trading, right? The reason for that is all the big hedge funds, banks, mutual funds, the big traders, they're taking vacation at this time around, right? When they take vacation, it causes a lack of volume in the market, which makes the moves much lesser, to trustworthy. Look at what's happening already. The market volume has consistently been declining over this year, right? Look at that. All the way from 2016, the beginning of 2016, where we obviously got a lot of volume. Since then, the market has just been drifting lower, and volume keeps on getting lower. And, that is potentially a cause of concern. So something to keep an eye on there too, okay? Now, taking a look at the QQQ, taking a look at the Qs, similar situation going on in the spiders, right? Similar situation, even the Qs have not taken out the low of Friday, this Thursday's red bar, which again could signal a 3-bar play. So you got a break of support with a big red bar, another little inside bar. Potentially this could be a 3-bar play to the downside, maybe all the way up in here, which would be this next area of major support. There's a little bit of support around here, right? But the next real major area of support is down in these lows right here. There obviously is going to be a little bit of support in this area because that's a gap fill, right? And gap fills can also act as support. So again, there is room to go down clearly on the markets. And even if you take a look at the higher time frames, the market do seem extended from their 21 EMA, and you can see we get extended from the 21 EMA. What happens? We rally into the 21 EMA. Market moves away from the 21 EMA on the monthly, pulls right back in. Market moves away, pulls right back in. Market pulls away, pulls right back in. Right, market pulled away from the 21 EMA, consistently pulls back, moves away, pulls back. Now we're again extended away from the 21 EMA, which could potentially cause a pullback in the markets here. So that's what's going on in the spiders as well. If you start taking a look at stuff like oil, oil obviously has been in no man's land. We've been talking about this trend line in oil coming all the way from way back there, and every time you start approaching this trend line, that's what seems to be going on. We approach this trend line, we start pulling back, start selling off, keep failing at this trend line. Whereas we also potentially had this uptrend line going here, which actually was surprising. This uptrend line actually ended up breaking, right? Broke to the downside. But here's what's happening: even though it broke to the downside, it has not been able to come back up. So technically, the oil is in a downtrend. And if you try, we can also kind of do it like this. So what's also happening is now oil has, once it broke out of this triangle pattern, has now entered this downward sloping channel, right? Pretty evident, pretty clear what's going on. So by this analysis, it could signal a potential move back down, unless, let's say it starts consolidating like it is right now, right? Finally gets above this 20, 10 and a quarter area, then that could potentially be a start of a move higher on oil. So right now, no man's land. I would just say if it breaks above this trend line, definitely long. If it fails under the 21 EMA, then it's probably going to pull right back down into this downtrending channel. Okay. Now, take a look at the gold. Similar situation. We talked about gold potentially creating a squeeze pattern. We kind of broke out of this little trend line. We had a little failed breakout attempt first. So 3-4 touches here, 5 touches failing at the trend line. Little peekaboo failed, attempt at breaking out. Was never able to hold above the trend line, so clearly a failed pattern. But now it tried to make an attempt yet again, and now it's finally above this trend line. So we're going to be approaching this little resistance level right here. But once that resistance level is broken, the gold does look higher. Okay, I would be inclined not necessarily buying gold above this trend line or anything like that. I think the first trade obviously was if you bought it above the trend line, that's fine. If you're not involved with it, I would just suggest to wait for a slight pullback right into the 120 area, and then potentially you could look for a secondary run higher on gold, right? But whenever we're looking at commodities like gold and oil, it always helps to take a look at the US dollar, because as you know, US dollar is inverse to the commodities. So if the US dollar is going down, commodities like gold, silver, are moving up, and vice versa. And look at that. That's exactly what's happening. We've seen the dollar basically just been getting killed. It's been downtrending for a while, and what's that caused? That's caused a slight bounce in oil, slight bounce in gold, right? That's because the dollar is getting cheaper. That's why the commodities are looking to bounce. Now, looking at dollar now, however, even though it has been downtrending for a while, it has now potentially approached an area of support, right? It has bounced off this area a few times before in the past, and now it's right back into that. So potentially this could be a bounce spot for the US dollar to go higher. How higher, we don't know, right? But next resistance area on the UUP is around $25. So I'm gonna keep an eye on the US dollar there. All right. Now, as far as trading is concerned, trading for us has actually been pretty good in 2017, right? Our swing trading portfolio has done great, and I've always told you guys that every single year I aim to make anywhere from 40 to 80% in my swing trading account. And what I hear is like, whoa, how is that even possible? How can you make 40% just like that? The mutual funds, the hedge funds, they're making 5-8%. How can you even make 40%? Well, first of all, it's very easy to make 40%, right? You can do that in a few months. And the reason why mutual funds, hedge funds only give 7-8% and I get way more returns is also because I'm trading a little bit aggressively, right? I'm trading a lot more aggressively compared to what the mutual funds and hedge funds do. And you also got to keep in mind, I might be trading with a trading with a 7-figure account or 6-figure account. And you guys, a lot of you guys are trading with 5-figure accounts, 4-figure accounts, 6-figure accounts, right? So for us, it's easy to get those type of returns. The reason why mutual fund and hedge funds can give those returns is because they're trading large sums of money, like billions and billions of dollars, right? And in a typical position, they're risking like 0.5% or less than 0.5%, right? Whereas I'm risking 2% of my account at every trade. And here's the beauty about it, right? So first of all, I hope you guys know what an R unit is, right? Which I'm pretty sure you guys know. But if you don't know, go to YouTube. There's a video that's on YouTube which covers in detail what R unit is that I made. If you can't find it, drop me an email and I'll happy to send it over to you, which covers how to correctly position size your trades. So now, here's an example. I'm risking, let's open the notepad here real quick. All right. So I'm risking, let's just say hypothetically, the account size is 100,000. You know what? A lot of you guys might not be able to relate to $100,000. So let's just say you have a $10,000 account. Okay. Now your risk per trade is 2% of your account. All right. So which basically means you are not going to be losing more than $200 per trade. So the $200 becomes your risk unit or R unit. All right. Now, if my goal in 1 year worth of swing trading is only to make 20 R's, I'm going to go really conservative. And you guys know how easy it is to make 20 R's. I hope you do, right? It's clearly possible to make 60 R, 80 R a year swing trading. But let's just say really simple. You need 20 R units per year. Okay, 20, that's it. You just need 20 winning trades, all right? Or of 2R each, okay? Or 10 of 2R each, right? Or 20 winners of 1R each. But let's just say you need 20 R units a year. Let's say you are able to do 20 R units a year. Now, your risk unit is 200. Your goal is to make 20 R units a year, okay? Which basically means 20 into, $200. Well, we can do the math here. $200 into, 20. You just made $4,000. Okay, so your total profit that year would be $4,000. Now, nothing to write home about, but now here's what it is. That $4,000 on a $10,000 account, that's a 40% gain. 40% gain. Now, here's what's going to happen next year. Next year, you're going to have $14,000. Let's just repeat the same process again. 20 R units a year, that's all we need. Right? Now, 2% of $14,000, what is that? Do the math. $14,000, right? Into 2%. Your R unit is now 280. So now you have a $280 R unit. Okay. Now again, we're only gonna make 20 R's a year. So $280 into 20. Let's do the math. 5,600. So now, in year number 2, you made $5,600. Okay. Now do the math. 14,000, 5,600. What percentage is that? Right? So if you keep doing that, look at the power of compounding. Look where you're gonna be in year 5, year 10. Right? And that's just assuming $10,000 account. Maybe you're trading with a $100,000 account, right? Now you just double this. Now it's a $2,000 per trade R unit, okay? $2,000. We'll just make this much. 2,000 into 20. Now you're making 40 grand a year, okay? And just do the math based on your account size. And hey, maybe you're aggressive. Maybe you know what? I want to risk 3% of my account every trade. I want to risk 5%. Hey, be my guest. Up to you. Totally up to you. That's individual preference. I personally risk 2%, but that's up to you. Okay. Now, did you guys just see? Just making 20 R units a year, you can make 40% on your account. 40%, no joke. 40%. So just by this math, you can see how easy it can be to actually swing trade. And we've actually done really well in the swing trade newsletter. We are crossing, over 20R units, and we're crossing over 40% for the year. And guess what? It's only August, right? We're already crossing 40%. We're already, crossing that 20R mark, and it's only August. We got August left. We got September, October, November, December. I mean, we literally got 5 more months. So if we can do this performance, in less than 8 months, think about what could happen by the end of the year. That 20R could turn into 40R, right? And that could mean an 80% year. So, if you treat trading like that, very statistical, very methodological, trading starts to become fun, right? And I mean, not fun, but it starts to become like a process, right? Like a business. When you go into, let's say, Chipotle or McDonald's, they have their process. They come in, they welcome you, you tell them what you want, right? They ask you, is it a meal or not? Do you want fries with that? Do you want small, medium, large? It's a process. You ask them, then you go to the other side, you collect your food. Same thing in trading. If you're coming in every day, you're looking for some setups. When you don't find a setup, you don't do anything. You just stay back. Don't let your emotions control trading. Like a lot of people, they feel like they should be trading every single day, every single minute, every single time. But as a swing trader, that's not the case. Swing trader, you want to be like a sniper. Find opportunities, get in, get out. When there's no opportunities, don't do anything. So I could go weeks without ever taking a swing trade, right? I could go months sometimes, well, pretty rare, but let's say go a month without a swing trade. And that's how trading sometimes is, It didn't take us a whole bunch of trades to make that 40% a year, right? Because I've seen when I was learning, when I was a member, and I was learning, what I found when I was trying all these services out, where they were trading like thousands of trades to get like 10-20% a year, right? Whereas I'm maybe taking 2 or 3 trades a whole month. A whole month might be 2 or 3 swing trades. Some months might be 5 swing trades. Some months might be 2 swing trades. And we're still able to get that amount of return, which is unheard of, because also by the stocks we're trading pretty regular liquid stuff, Baba, Netflix, whatever we're seeing opportunity. So we're trading regular big stocks, right? And any other service that is comparable to this newsletter that can give more than 40% returns are all penny stock people, right? They're trading stuff that I wouldn't even touch with a 10-foot pole, right? And no professional trader trades penny stocks, okay? They're all marketers, pumpers, dumpers. I mean, you gotta focus on trading stocks that is regular, high volatility, but at the same time also give you opportunity, because trading is all about controlling risk. And with penny stocks, these little guy stocks, you cannot control your risk. It's all about who's the loudest, who pumps the most. That's what little guy stocks are all about. As the name goes, they are for little guys, right? People who are professional traders, we focus on stuff like, Netflix, Baba, Amba, Perigo, like, regular big stock, Johnson & Johnson. Because that's where the money is made in a consistent, profitable manner, right? I don't know any successful trader who's been trading penny stocks, or who only specifically trades penny stocks. I don't know a single person who can make money consistently, without pumping their own stocks, okay? So now that we've got that out of the way, the performance is obviously great in the newsletter. We're just killing it despite, 1 or 2 losses we might have seen here. Overall, we're killing it. We're doing extremely well, right? And my goal is to continue to do well, okay? Continue to do well as we go along this future and as we go along this year. I close the year strong. We've been having fantastic year. I think 2014 I did like 70%. 2015 I made over double-digit, triple-digit returns, 100%. 2016 was a little bit on the low side. I would say about 29%. But now 2017, now back again. We're so already over 40. So by the end of the year, I don't know where we're going to be, but it's just been great. All right, so that was just a part of the newsletter where I just went over some of my thoughts, explained it a little bit better. We looked at the spiders, the Qs, the USO, the oil, the gold, and now let's dive into some brand new trades that I'm watching and I'm looking to get into. All right, so let's dive in.